Hi, this is Retz Reeves. I'm your International Equity Portfolio Manager at IIM, and I just wanted to update you on what we're doing on the international side. One of the questions I always get is, why should I invest internationally? There's plenty of U.S. stocks out there, and the reason that I did the slide was just kind of update you on my viewpoint on why to invest internationally. One reason is for opportunity. There are many stocks that are really interesting outside of the U.S., that are domiciled outside of the U.S., which is the definition of international. And by going abroad, you have an opportunity to participate in the growth of those companies. Some of the stocks that you might recognize that are not U.S. are companies like Nestle, Toyota, Bayer, Unilever. Again, when you invest internationally, you have a chance to participate in them. Also, investing internationally is an opportunity for diversification. Different economies are typically in different stages of development or advancement in their business cycle, and this gives you an opportunity to diversify across business cycles by investing in other countries. Finally, international investing also gives you the opportunity to hedge. In this case, I'm talking about hedging your currency risk. We suggest that you try to match, to some extent, your investments with your hard assets that you own. So by investing internationally, you're matching some of the currency with some of the hard assets that you own, like your cars, for instance, or your electronics. And hedging also helps on the currency side with the fact that there's times when the US dollar might be up or down, and other currencies might benefit from that dynamic. We have three main international offerings. Frigate and Treasure Harbor are ADR, American Depository Receipt portfolios. Frigate is used for capital appreciation. It's typically large cap companies whose price to prospective earnings are attractive relative to their history. Treasure Harbor is more focused on dividend yield, typically larger companies, and I do pay attention to other valuation metrics, but what I would like to find is that the company is experiencing growing dividends. Yellowtail is a bit of a different animal, literally. This is a small cap portfolio or mid cap, with stocks with a market cap of less than 10 billion, as opposed to 50 billion or even 100 billion plus for the other portfolios. Typically, these companies, you need to go abroad to actually purchase them. They're non-American depository receipt. So the platform for Yellowtail is different than the platforms for Frigate and Treasure Harbor. Yellowtail focuses again on smaller cap companies with attractive PE ratios and good earnings growth. It tends to be more volatile, but it also can yield very good returns in some years. In fact, these are the returns for the portfolios since inception, and also year to date, and the total returns in 2016. This was a pretty good year for all of our portfolios, and these returns are actually net of management fees and net of taxes that have to be paid on dividends, sometimes in international countries. Looking further as far as the performance is concerned, year to date, even after what was a pretty good period, these portfolios are all up approximately another 1% since this was recorded. This is the regional allocation for Frigate. It does have a lot of exposure to Europe and the UK, but it also has good exposure to emerging markets, to Japan, and rest of the world. And rest of the world in this case would be Canada, Australia, and other countries that don't fit the dynamics that I just mentioned. This is the industry allocation in Frigate. Again, we can see that it's very well diversified. Banking is the top of the wheel to the right, and then the rest of the exposure by industry continues going right around the wheel or clockwise around the wheel. The largest segment is in healthcare, but that's a little of actually it's more diversified than that. Healthcare includes drug companies, generic companies, but also service companies, for instance, like Fresenius, which does dialysis, and Smith & Nephew, which is involved with implants. So again, it is pretty well diversified. Treasure Harbor has a different makeup as far as geography is concerned. Close. There is still a good European exposure. And one of the reasons we see the European exposure very high, both for the UK and for domestic Europe, is these countries typically have companies in them that have the ADR capability, that American Depository Receipt capability. For instance, in Japan, it's a lot more difficult. The reason you see a little bit higher exposure in Canada and the UK, as we'll see on the next slide, is because they tend to have some defensive sort of industries with good dividend payouts. In fact, on this slide, you see that the sector makeup is different than what we saw in Frigate. There's a higher exposure to telecom and staples, for instance, and financials and materials. Those are industries that typically pay nice dividends. Yellowtail. Now, you will notice that I've used different graphics for each of the different portfolios. Let me know which ones you like the best, and we'll keep that in mind for our next presentation. So with Yellowtail, I broke it down a little bit more for you as far as the countries to which there is exposure. If you notice, there is a high exposure to France, which is the upper right-hand almost quadrant, and to Switzerland. That just happens to be where we have found like a lot of opportunity, a lot of fast-growing companies that still have attractive valuations. But it is still well diversified. You'll see there's China in the emerging market space. We have New Zealand, even South Africa. On the diversification as far as sector is concerned, or industry, you see that the makeup is a little bit different than the other portfolios. Yet healthcare, not surprisingly, is a part of it because there's a lot of small, fast-growing healthcare companies. But you also see a big exposure to industrials. And that's not unusual on a small or mid-cap because typically these companies that are growing often started out as small family businesses, especially within the industrial sector or supplying the industrial sector with parts or automation. Also within the industrial sector, there are service types of industries. One of the ones we mentioned before is Orpea, which is a nursing home in France. That actually would fall under healthcare, but many other service companies would fall within the industrial classification. One of the reasons that we talked about before about investing internationally is the idea of exposing oneself to different economic opportunities. This is the first time in a while where we've seen the global growth outlook for U.S. and abroad start to look a little bit better as versus what we saw in 2016. And we see that emerging markets are starting to come back as far as growth projections are concerned. There's a lot more stability in the emerging markets outside of some places such as Argentina. And we still see that there's good growth expected for the advanced economies as well. And part of that comes from the international markets, especially as we see Europe start to trailing the U.S., but starting to improve. It wouldn't be fair really to talk about the outlook without mentioning the risks, but the risks can be both good and bad. And so finally, I want to touch on this. The geopolitical risk, it is a risk right now, probably more to the risk side, and that has to do a lot with the situation with North Korea right now, which we cannot guess what's going to happen on that end, but certainly it has created a bit of stress. Legislation is also to some extent a risk because of the uncertainty involved with it. All around the world, different lawmakers are taking different stands on issues that could impact us good or bad. Maybe the U.S. is going to lower its tax rates. Maybe within the UK, they're going to let less labor come across the borders to help. and that might even change the whole dynamic of the financial front in Europe. Policy changes are linked to legislation, but actually these risks, legislation, policy changes, and inflation, were highlighted by the most recently World Economic Report as what they are worried about the most. And in this case, policy changes are the idea that perhaps countries will be more locally focused, more protective of their own economies, that brings a risk to the global trade. Finally, inflation can be good or bad. If you ask Japan, they would have liked inflation. But inflation can also have an impact on not just the cost it takes in order to make products or deliver services, but it also could have an impact on interest rates. At this point, the risk is to the upside to some extent of inflation, but still much lower than what we've anticipated in the past. Well, thank you for listening to this update. And if you have any questions, please feel free to contact us. Thank you very much.